Wait, what? I can do that? Welcome to this episode of Wait, What? Business Matters That Matter for businesses and the people who own them. It is my pleasure to have for this first episode David McKnight, author of The Power of Zero. The revised and updated edition does a deep dive regarding taxes now, after President Trump and Congress put the tax cuts in place for 2018, and what we may experience come January 1st, 2026, when the cuts are going to sunset or expire. But let me give you some background on David first. David McKnight graduated from Brigham Young University with honors in 1997. Over the past 20 years, David has helped put thousands of Americans on the road to the 0% tax bracket. He has been featured in Forbes, USA Today, the New York Times, Fox Business, Bloomberg Radio, MarketWatch, CBS Radio, CNBC, Yahoo Finance, NASDAQ.com, Investors Business Daily, and numerous other national publications. David was a focused speaker at the worldwide annual meeting for $1 Million Roundtable in Toronto, Canada, and is a multiple top of the table qualifier. His best-selling book, The Power of Zero, has sold over 185,000 copies, and the updated revised version was published by Penguin Random House when it launched in September of 2018. It finished the week as the number 2 most sold business book in the world. In 2019, The Power of Zero was ranked as the number 9 best financial resource in the country by Forbes magazine. This book was recently made into a full-length documentary film, also entitled The Power of Zero. As president of David McKnight and Company, he mentors hundreds of financial advisors from across the country who specialize in the Power of Zero retirement approach. He and his wife, Felice, have 7 children. David, thanks for joining us today.
You're welcome. Thanks for having me.
You know, David, I just kind of wanted to get into the questions. I know you're busy and we only have so much time, and your book goes over a lot. I mentioned in the intro that your book discusses taxes now and where they'll go in 2026, just 7 quick years from now. It seems we are in a low tax environment now for corporations, individuals, and married couples. I basically have a 3-part question for you. Am I correct that we are in a low tax environment? Where do you see things going in the future, and why?
Yeah, we are at historically low tax rates. There's no question about that. Some people will say, well, Dave, tax rates were slightly lower under George W. Bush. The highest marginal tax bracket was 35%. Now it's 37%. While that's true, I'm also here to tell you that the income parameters that define today's tax rates are as low as we've seen them in our lifetime. So, taxes are on sale. Tax rates have nowhere to go but up. And the reason why, and not a lot of people can sort of articulate exactly why tax rates are going to go up. You know, I give about 85 presentations across the country every year, and I ask rooms full of people, hey, how many of you guys think tax rates are going up? And in nearly every room, every hand goes up. And then I ask them why, and sometimes they have a hard time articulating exactly why. But a lot of times I think they have a sense for it. We have made promises as a country. Well, the government's made promises to 75 million baby boomers, as well as the rest of us, for things like Social Security, Medicare, Medicaid. And frankly, we had promised way more than we can afford to deliver. The government tells us that the publicly outstanding debt is $22 trillion. Truth is, it's actually a lot higher than that, because that $22 trillion number does not include all of the unfunded obligations for Social Security, Medicare, Medicaid. In other words, the promises that we've made, if we were to put that on a balance sheet, the debt would no longer be $22 trillion. If we did our accounting like every other country in the world does their accounting, where they include the promises for pensions and medical programs on the balance sheet, we would actually have a publicly stated debt of $239 trillion. So it's 10 times worse than what the government is telling us. So the reason why most experts believe that tax rates in the future, even 10 years from now, are going to be dramatically higher than they are today is because we've made all these promises and we have no idea how we're going to pay for it all. There's a guy named David Walker who I pay a lot of attention to. He used to be the Comptroller General of the federal government. That means he was the CPA of the USA. He did that for 10 years. He said back in 2011, the tax rates would have to double to pay for all this stuff. And that was back when we only had $10 trillion of debt. Now we have $22 trillion of debt, and it's growing by $1 trillion every year. That number is going to grow to $2 trillion. We're going to get to the point where we have $53 trillion of debt. And the scary part about that number is if we had $53 trillion of debt, all of the revenue flowing into the U.S. Treasury at that point under today's tax rates would only be enough to pay the interest on all that debt, let alone any principal, let alone a single dollar for Social Security, Medicare, Medicaid, or any of the other expenses in the budget. So we have really painted ourselves into a corner here where we literally either have to cut spending by half, meaning people are going to get half as much Social Security as they thought, half as much Medicare as they thought, or we have to double taxes or some combination of the two. So it's 10 years are going to be very interesting because unless we make massive cuts, there's going to be no choice but to have massive increases in the tax rate.
David, you said that Social Security, Medicare, Medicaid, and the debt on our system puts a big strain on the government. And I remember reading in the book by 2020, it's going to be about 92 cents of every dollar, leaving 8 cents for all the other stuff, the Army and everything else. Could you kind of elaborate on that? How much is going towards that?
Yeah, so most of the money in the budget are things that we can't control. What does that mean? That means that it's not discretionary spending. It's non-discretionary spending. Those are things that we're required to pay by law. Most people don't realize that, but Social Security and Medicare, we are required to make those payments and adjust them for inflation each and every year. And it would take an act of Congress for the federal government to reduce that or to not pay it at all. So we are in a position where the federal government has to make certain payments every year for those programs. And so there's only so many things that are in the budget that can be reduced. To reduce all of the other, the non-discretionary things requires an act of Congress. And frankly, nobody's getting anything done in Congress these days. So the only things that we have control over are, FBI, National Park Services, defense. And frankly, all of those things aren't enough to be able to pay for all of the things that we promised that we can't afford to deliver on. So we're in a real bind here where come 2020, moving forward in time to 2025, interest on the debt alone is going to crowd all of these other expenses out of the budget. If all we did was return to historically normal interest rates, that would quadruple the amount that we're spending just on interest, just to pay for the money that we've already spent, just to rent the money we've already spent. So it's really coming down to the wire here. Most people don't realize it because the federal government doesn't like to talk about it. It's not a very popular thing to talk about, so politicians don't talk about it, which is why I've been out crisscrossing the country trying to raise a warning cry to people that things are much, much worse than anybody's actually telling us.
You know, David, it seems like we have a very divisive government right now, meaning Republican versus Democrat. But this problem is not even a political problem. It's just a situation of plain math and mathematics. Would you agree? Yeah.
So I'll tell you a quick story. When I was given my presentation to a group of folks in Fond du Lac, Wisconsin, it was actually 2 days before midterm elections back in 2009. It was 10 years ago. So everyone came up to me and they said, Dave, we agree with you. There's this huge problem. Who should we vote for? And I said, it doesn't matter who you vote for because whoever gets elected is going to inherit a math problem. And the only way to solve that math problem is either by doubling taxes, reducing spending by half, or some combination of the two. So it really doesn't come down to politics. It comes down to math. And the party in Congress that knows how to solve this math problem is the one that will, frankly, earn my vote.
Dave, I read one thing in your magazine that really caught me, and it was the subject of provisional income. Can you share with the audience what provisional income is and the adverse effect that it has on a person's Social Security?
Sure. So back in 85, Ronald Reagan got together with Tip O'Neill, and they said, hey, Social Security is going bankrupt. What can we do about it? So they struck a deal whereby they could start taxing your Social Security benefits. I think that back then the worst it could be was 50% of your Social Security benefits could become taxable to you. And that sort of kicked the can down the road. And then back in 1992, Bill Clinton and Newt Gingrich, I believe, got together again and said, Social Security is going to go bust in the next couple of months. What can we do to shore it up? And so they said, okay, let's now make it so that 85% of your Social Security can become taxable to you at your highest marginal tax bracket. So what they do to figure out if they're going to tax your Social Security or not is they keep track of something called provisional income. And provisional income is basically any 1099s coming off of your taxable investments like your CDs or your savings or your money markets or just plain old taxable stocks and bonds. And then any distributions coming out of your tax deferred bucket, things like 401ks and IRAs, that counts. And by the way, also 1/2 of your Social Security counts as provisional income. So they add all this provisional income up. And if as a single person, it adds up to more than 34,000, or if as a married couple, it adds up to more than 44,000, then up to 85% of your Social Security becomes taxable to you at your highest marginal tax bracket. So that's a big deal, because how do most people compensate for this huge hole in their Social Security? They start taking money out of their other investments like their 401ks and IRAs. I'll give you a quick math example that I like to give people. If tax rates went up to 50% like David Walker has predicted, and you had a $5,000 hole in your Social Security, you'd have to take $10,000 out of your IRA or 401k to be able to pay that 50% tax to the IRS, and then be left over with $5,000 with which you could then plug the hole in your Social Security. So I've done the math 100 times in 100 different ways on 100 different clients. And what I've discovered is that when your Social Security gets taxed, you run out of money 5 to 7 years faster than people who do not have their Social Security taxed, because the act of compensating for Social Security taxation forces you to spend down all your other assets that much faster. So Social Security taxation is a huge deal. Fortunately, if you're taking money out of true tax-free investments like Roth 401ks, Roth IRAs, Roth conversions, some forms of properly structured life insurance, then you can actually be in a position where you can actually get your Social Security tax-free.
And it seems like with people living longer, I know when Social Security was first formed, the average life expectancy was 62, and you couldn't collect till you were 65.
Right.
And now we're living into our 80s, and that's putting a definite strain, 80s and beyond, that's putting a big strain on our whole system.
Yeah, Social Security, I like to tell people Social Security started off as insurance against living too long. I mean, the average person only lived on Social Security a couple years, and over time it's transformed into this pension program that covers us for nearly a quarter of our lives. The average person who draws Social Security at 62 will continue to draw Social Security on average until age 85. A lot of people think, hey, average life expectancy is 77 for women, 77 for men, 78 or 79 for women. That's true, but that includes infant mortality and all the bad things that can happen to you up until age 62. The truth is that if you make it to 62 and start drawing on Social Security, you will continue to draw until age 85. And that has put a massive strain on the Social Security program. And frankly, Social Security is going to go bust in 2032. That's not even to say, hey, they can't even pay all of their bills. They can't pay any of their bills in 2032. Medicare goes bust in 2026. So we're in a position where these two major programs that, a quarter of Americans are going to be relying on here pretty soon. They're not going to have enough money, not even enough money to pay their bills. They're going to be completely bust, completely broke by those two dates that I specified. And the only way to really fix these programs is either cut them in half or double taxes, or some combination of the two. So we're really coming down to a wire. And frankly, the federal government does not want to talk about this at all.
Right. Just to kind of shift gears a little bit, there were two main sources of tax-free income you discussed in your book, for people planning for retirement: the Roth IRA or the Roth conversion for those who may have, 401k money sitting in their IRA somewhere like Schwab or someplace of that sort. And you also talked about the LIRP, or life insurance retirement plan. I know there could be more sources of tax-free income if you do some proper asset shifting, but I want to kind of focus on the Roth right now. Roth, and it seems Roth conversions can be a little bit tricky if it's something that you need to know the rules around. Could you elaborate on that?
Sure. There's a couple of rules on the Roth conversion. Number one is generally, if you're doing a Roth conversion prior to 59 and a half, you can't pay the tax on that conversion out of the IRA itself. You got to have a bunch of money sitting around in your taxable investments that you can earmark for that tax bill. Not everybody has that, so not everybody's in a position to be able to do a Roth conversion. The other thing is the IRS has a special rule that prevents you from doing a Roth conversion prior to 59 and a half simply as a way to get access to your money. So, for example, if you did a Roth conversion at age 50, say you converted $100,000, the IRS is not going to let you tap into that money right away. They are going to require you to wait for 5 full years until you can access that Roth IRA. So technically, you can touch it prior to 59 and a half, because by that point you would be 55. But each conversion that you do has its own 5-year sort of marination period where you can't touch it without a penalty. Now, there used to be income limitations on who could do a Roth IRA. I believe in 2011, the IRS got rid of those income limitations. So now anybody, even Bill Gates, can do a Roth conversion as long as they're willing to pay the taxes associated with that conversion.
You know, David, there was a little small known tax code called 72T. Could you explain how that works?
Yeah, so if somebody doesn't have the tax, the money in their taxable investments to be able to pay the tax on a Roth conversion prior to 59 and a half, there's another little known section of the IRS tax code. It's section 72 subsection T. In our industry, we just call it 72T, which basically says that you can take money out of your IRA pre 59 and a half without penalty, so long as you do it in separate equal yearly distributions that last for at least 5 years or until 59 and a half, whichever's later. So for example, if you're 50 years old, you got $500,000 in an IRA, you want to take some of that money out, you can do so, but you have to start that stream of income and you have to go until you are 59 and a half. So you have to do it for 9.5 years. These days, by way of a 72T, you can take out between 4 and 5%. It's called 5%. So that means you could take out $25,000 per year every year for those 9.5 years out of your IRA. You will have to pay tax, but you won't have to pay the penalty.
Right. Well, that's good. That's helpful anyway. Hey, David, I want to ask you, I have a guest coming on in another episode that will focus on the LIRP, or the Life Insurance Retirement Plan. But could you give us your thoughts at a 30,000-foot level regarding the importance of this savings vehicle for, business owners and individuals themselves?
Sure. And I'm always pretty clear to tell people that the LIRP is not a silver bullet. It does some things that some of these other tax-free streams of income can't do, but it's best used in concert with all of these other tax-free streams of income. So in other words, when you get to retirement, you don't want to draw on just one stream of tax-free income. You want to have multiple streams of tax-free income, none of which show up on the IRS's radar, but all of which contribute to you being in the 0% tax bracket. So a typical person that approaches retirement might have money coming out of a Roth IRA, a Roth 401k, a Roth conversion, and then also potentially this life insurance retirement plan. Basically, the life insurance retirement plan is a bucket of money. You put money in. As your money grows, the bucket fills. Only the IRS says that the growth on the money in this bucket is going to be treated under a different section of the IRS tax code than anything else we've talked about so far. And what that section of the IRS tax code says is that you can touch the money pre-59 and a half with no penalty. As your money grows, you receive no 1099s. And when you take the money out, if you take it out the right way, it's not going to show up as reportable income on your tax return, which means it's tax-free, and it also does not count as provisional income. They're also going to tell you that there are no income limitations. This is going to be big for a business owner. So whereas a business owner couldn't otherwise contribute to a Roth IRA because they make more than $203,000 of modified adjusted gross income, there are no income limitations on the LIRP. There's also no contribution limit. So whereas with a Roth IRA, if you're over age 50, you can only do $7,000 per person per year. So a married couple could do $14,000 per year. With the LIRP, there are no limitations on how much you put in. So I've got clients that do $50 a month. I've got clients that do $200,000 per year and everywhere in between. And finally, I think this is worth exploring, at least mentioning. if history serves as a model, there may be no legislative risk, meaning historically, when they changed the rules on the LIRP, and they did so in 82, 84, and 88, they simply said whoever has the bucket of money before the rule changes gets to keep it and continue to put money into it under the old rule for the rest of their lives. We call that a grandfather clause. So there's a number of things that make this a very attractive vehicle, but the IRS says, hey, if we're going to give you the benefit of an unlimited bucket of tax-free dollars, we're going to require that there be a cost of admission. We're going to require that there be a spigot attached to the side of this bucket through which flow on a monthly basis some expenses, and those expenses go towards the cost of life insurance. It's called annual renewable term life insurance. And so a lot of people say, hey, look, I'm approaching retirement. Maybe I don't need all this life insurance. And so the companies that sponsor these programs say, look, we recognize that, so we've done something to sweeten the pot. We simply say that in the event that somewhere down the road you should need long-term care, they will give you your death benefit while you're alive for the purpose of paying for it. That's a big deal because traditional long-term care insurance gives a lot of people heartburn because nobody wants to pay for something they hope they never have to use. At least in this scenario, if you die peacefully in your sleep 30 years from now, never having needed long-term care, someone's still getting a death benefit. So there isn't that sensation of having paid for something you hope you never have to use. So the LIRP can be very useful because it has some flexibilities that you may not find in all these other tax-free investments, but we have to remember that it's most powerful when used in tandem with these other tax-free. You never want to have all your eggs in one tax-free bucket.
Final question. I just want to ask you, is there anything top of mind that you might want to discuss that I may not have asked that would benefit our audience?
I think that it's probably important to recognize, it used to be that people would ask me, they'd say, Dave, when are tax rates going to go up? And I'd say, in some distant, unknowable future, maybe 10 years from now, tax rates are likely to go higher. Well, guess what? With these new Trump tax cuts, we now know the year and the day when tax rates will go up. In order for tax rates to go up, all Congress has to do is nothing. And frankly, Congress is pretty good at doing nothing because these tax cuts have a sunset provision. That means that they automatically expire on January 1st, 2026. So we have this 7-year period during which to enjoy historically low tax rates. I tell people tax rates are on sale. The updated revised version of my book, chapter number 6 is called The Tax Sale of a Lifetime. I basically make the case that taxes will never be lower in our lifetime than they will be during these next 7 years. And that every year that goes by where you fail to take advantage of these historically low tax rates is potentially a year beyond 2026 where you could be forced to pay the highest tax rates of your life. So take advantage of these low tax rates to get dollars positioned from your tax-deferred investments to tax-free investments. You will pay a tax. I give you permission to not enjoy it, but I guarantee you 2030, you'll look back on the year 2019 and say that was the deal of the century. Tax rates were historically low. I'm so glad I took advantage of those tax rates.
Well, David, I want to thank you for your time. And for those listening, the book is The Power of Zero. It's an extremely good read. And you can always feel free to contact me at eb@wait-what.biz. Thank you. Thanks, David.
Thanks for having me.